Hello, and welcome to Live Wire Markets and our series of short, snappy ideas, The Pitch. I'm Huntsley, and our conversation today is about China. Investors have been banging the door for a stimulus bazooka from Beijing for a long time, and none more so than Aussie resources investors, given how important the Chinese market is to those companies. But are they getting what they want? Joining me to break that topic down is McLean of Fidelity International. Good to see you, Casey. Welcome.
Hi, Hans. Great to be here.
We've seen some massive moves in China as of late. I mean, the CSI 300, I think, is up 30% since its mid-September low. So I was wondering, could you take a step back and illuminate us all? How did we get here and what caused this rally?
Well, the Chinese market and economy has been under pressure for a number of years now, since the reopening in COVID. We've seen growth slowing. The economy's in deflation. They've had deflation in 7 out of the last 8 quarters. And really, the consumer's not spending. They're saving or paying down their mortgage. And I think that growth, that lack of growth really reached its sort of endpoint, and the government decided enough was enough. And as you say, in late September, mid-September, they announced some monetary policy easing. They lowered interest rates. They cut mortgage rates for existing mortgages and lowered the reserve requirements as well for banks. So that lowered the cost of funding, increased liquidity into the system, which is good. But we really need demand stimulus as well. And they followed up immediately after with a statement that fiscal stimulus was coming. And that led to the rally in China's equity markets. In Australia, the resource sector rallied quite strongly, and banks sold off as the key sort of funding source then. But in a series of announcements since then, that big bang, the bazooka that you mentioned, it didn't really come. It was much more of a whimper, and that really culminated with the MPC in November, where they did announce a big local government debt swap, but they really didn't address the key issues that the market was looking for on consumption, the property destocking and recapitalising of the banks. So since then, the market has given back some of these gains.
With that kind of backdrop, have you made any changes to your portfolio in light of this? Were you cycling out of the banks and into resources during that big run?
We are currently underweight the banks, and really that's because we don't think the fundamentals and valuation, they're mismatched. If you think about banks, their returns are in structural declines. Mortgage returns are below the cost of capital, and yet competition is increasing, which is not really a rational position to be in. We continue to be underweight in the banks, but conversely, in resources, we have been adding to resources prior to the Chinese stimulus announcement in August, and we've been adding to iron ore, where seasonally it is a good time to be buying iron ore, especially when the iron ore price is at the level of cost curve support. We've also been adding to copper, and there is some risks around copper in the near term. Potentially, if Donald Trump rolls back some environmental measures or implements tariffs, copper being the key arbiter of global economic activity, there could be a dent in demand there as well. But long term, we see the supply-demand dynamics as really supportive, and structural deficits coming in the later years in this decade, driven by that decarbonisation spend. And indeed, we actually think that copper supply is going to be the limiting factor for decarbonisation, rather than the sticks and carrots, the incentives and penalties that the governments are imposing to force decarbonisation. So we've been buying stocks in those sectors where we also see good long-term company-specific growth and reasonable valuations at the same time.
Pertaining to kind of what you were saying at the beginning there, my next question was going to be, what were the biggest risks that investors should be looking at? But maybe is the biggest risk that China just doesn't deliver this stimulus bazooka at all, or they actually just don't answer the questions that the market has that you were pertaining to?
That definitely is a downside risk. I think if there's no stimulus measures and coupled with large-scale economy-wide tariffs that Trump implements, you are going to see disruptions of trade flows, weaker growth in China, and the Chinese consumers just continue not to spend. But I think there are risks to the upside as well. The Chinese authorities have left the door open for more stimulus measures down the track, and it is likely that they're taking a bit of a wait-and-see approach to what Donald Trump is going to implement. And if he does implement the tariffs, they could stimulate domestic demand to offset that, or even depreciate or devalue the Chinese renminbi, which the Australian dollar is highly correlated to generally, which could be good for Australian exporters, particularly those US exposed exporters who are also going to benefit from a potential tax cut in the US.
All of this wrapped up then, you talked a little bit about adding to some positions and resources, but outside of resources, do you expect that there are other companies or sectors that could benefit from Chinese stimulus?
Yeah, I think it really does depend on reigniting the animal spirits in the Chinese consumer. Even in the absence of that, I think a company like Treasury Wine looks fairly well placed. They've only just had their tariffs that China imposed on Australian wine removed. And that, coupled with a really strong vintage this year, means that they've got good volume growth in their key brand Penfolds for the next few years. And at the same time, if demand increases, because it for all sources that we look at, it appears that the brand equity in China has not been diminished over this period where the tariffs are in there. So if demand increases, it's going to lead to price rises as well. So you can see good, strong growth in their wine, in their Penfolds division. And at the same time, they're talking about divesting their less than premium, their commercial grade wines, refocusing on that premium luxury segment as well. And it's a stock that's trading near its historic lows in terms of valuation.
Okay. Casey McLean of Fidelity International, thanks very much. And thank you for joining us for The Pitch. If you enjoyed that interview, you can subscribe to the Live Wire Markets website as well as our YouTube channel. We'll see you next time.